Hello everyone, myself Mukesh Mishra and I'll be starting a new chapter of our subject accountancy. The chapter name is Evolution of Accounting and Basic Accounting Terms. So if we are going to the history of the accounting, so it start the details we are getting in the book is the seeds of accounting were most likely first shown in Babylonia and Egypt around 4000 BC, who recorded transaction of payment of wages and taxes on clay tablets. Means whatever historical evidence we are having, so according to that, the history of accounting has been started had been started in Babylonia and Egypt around 4000 BC. Historical evidence indicates that Egyptians used some form of accounting to keep records of treasuries where gold and other valuables were stored. The in charge, the in charge of treasuries was required to send day-wise report to their superiors, known as wajirs, who in turn used to send money who in turn used to send month-wise report to kings. In Babylonia, known as City of Commerce, accounting was used to uncover losses occurred due to frauds and inefficiency. In Greece, accounting was used to maintain records of revenue received in treasuries. The records consisted of opening balance, total receipts and expenditure, and the closing balances. Romans used memorandum or day books wherein receipts and payments were recorded and their form from posting to ledger were made on monthly basis. As far as India is concerned, in India, accounting could be traced back to 23 centuries ago when Kautilya, minister of Chandragupta kingdom, wrote a book titled Arthashastra, which described how accounting records had to be kept. Apart from that, various other historical evidence proves that accounting originates where and in which country. So, after that evolution of accounting, we are going to discuss a few very important terms in the chapter, which you are going to face later on in various subjects. The terminology you are going to face in the subject later on. A very first term of accounting is a business transaction. So, a business transaction is an economic activity of the business that changes its financial position. Whenever any business transaction takes place, it results in a changes in the value of some of assets, liabilities, or capital. So a business transaction is an economic activity. It's an economic transaction which involves money as well, and because of which there is certain changes in the assets and liabilities or in the capital. Apart from this business transaction, we will come to the topic event. Event is the consequence of a result of a transaction. When you have a business transaction, there is a substantial changes in the assets and liabilities. There is a change. There are changes in capital, value of capital. So the changes you are going to face in the various balances are known as event. Next, account. In actual practice, the individual transaction of like nature are recorded, added, and subtracted at one place. Such place is customarily termed as an account. Prior to understanding the meaning of debit and credit, it is essential to understand the meaning and the form of an account. Account is a place where you used to record all the things, all the transactions related to a particular thing. An account is a record of all business transactions relating to a particular person or an item. In accounting, we keep a separate record of each individual assets, liability, expense, or income. The place where such a record is maintained is termed as an account, such as the account of Ghanshyam, account of Ram. Like we can have an example of account of Ghanshyam. If you are purchasing goods from Ghanshyam, we used to record all the purchases related from Ghanshyam at a specific place. Then whatever payments we have made to Ghanshyam will be recorded in that particular account. So at a single place, we can know that what amount of goods we have purchased from Ghanshyam, what amount we have paid to Ghanshyam, and what is the amount left to be paid to Ghanshyam. We have a definition given by Mr. Carter. An account is a ledger record of summarized account of all transactions that have taken place with a particular person or a specified or things specified. I'm sorry. An account is a ledger record. It's a ledger record. Ledger we had discussed earlier that in accounting practice you are going to face certain chapters like journal, ledger, and trial balance. So ledger is that particular thing where you used to post all the transactions from journal. An account is a ledger record in a summarized form of all the transactions that have taken place with a particular person or thing specified. Then we have a next point, capital. What is capital? It refers to the amount invested by the proprietor in a business. A very important term. Capital we have studied earlier also. Capital, the capital of a state, the capital of a country. Here the capital meaning is different. The amount invested by the owner of the business. The amount invested by the owner of business is known as capital. Amount may be in the form of cash, goods, or assets. It's not important you are always investing cash into the business. You can invest any form of assets in the business. That assets may be considered will be considered as capital of your business. It is the amount with the help of which goods and assets are purchased in the business. This is the initial amount we have invested in the business, and from that particular amount we are going to purchase assets and goods for our business. As such, in order to calculate the amount of capital, all current assets and fixed assets are added up and external liabilities is deducted out of it. So we can have a formula of it also. Capital is equals to total assets minus external liabilities. Then we have next point, drawings. Drawings is a very important term you will be facing in the practical questions as well. Drawings, any amount, any cash or value of goods withdrawn by the owner of the owner for his personal use. Means let us assume I'm the owner of a business, and if I'll be withdrawing anything from my business for my personal use, it will be considered as a drawing. It will be considered as a drawing of mine. So, being owner, if you are withdrawing anything from the business for your personal use, it will be considered as drawings and it will be treated as a loan taken from the business. The next thing is liability. It refers to the amount which the firm owes to the outsiders. Liability is the amount which you owe to the outsider, the amount you have to pay to somebody else, or the amount you have to pay to the outsiders of the business. In the words of Finney and Miller, liabilities are debts. They are amounts owed to creditors. This can be expressed as liabilities is equals to assets minus capital. Liabilities, if I am talking about liabilities, means external liabilities basically. Then we have further classifications of liabilities as well. Liabilities may be divided into two parts, internal liability and external liability first. So all amounts which a business entity has to pay to the proprietors or owners are internal liability. The amount which a business has to pay to the owners or to the internal persons of the organizations are known as internal liability. The examples of such internal liabilities, capital and accumulated profit, the amount which has been invested by the owners. It is the responsibility of the business to repay the amount at the winding of the business. अगर business कभी wind up होता है तो इस amount को हमें owners को वापस करना होगा. Being a business, it's a responsibility, it's a liability of the business. Then second point is external liability. All amounts which a business entity has to pay to outsiders are known as external liability, such as creditors, bank overdraft, etc. So if I talk about external liabilities, so whatever the amount we have taken, we have received from outside of the business, and later we have to pay that amount, that is known as external liability. The examples of such liabilities are creditors, bank overdraft, loans, etc. Liabilities may be further classified into two parts, as a non-current liability and current liability. When it concerns to non-current liability, these refers to those liability which fall due for payment in a relatively long period, say more than a operating cycle or more than an accounting period or more than an year. The liabilities which are to be repaid after an year, normally after an year, are known as non-current liability. Whereas the liabilities which are to be paid within a year, which are to be repaid within a year, are known as current liability. The examples of non-current liabilities are long-term borrowings and debentures, and the examples of current liabilities are bank overdraft, bills payable, creditors, and outstanding. The basic difference between non-current and current liabilities are non-current liabilities are to be repaid after an year, and current liabilities are to be repaid within a year. Then comes to next point, assets. Anything which is in the possession or in the property of a business enterprise, including the amount due to it from others, is called an asset. Anything which is in the possession of or is the property of the business, anything, any property which is in the possession of our business or which are to be received from others are known as our assets. In other words, anything which will enable a business enterprise to get cash or a benefit in future is an asset. Anything which are going to provide us benefit in future can also be known as asset. Thus, cash and bank balances, stock, furniture, machinery, and building, bills receivable, debtors are some examples of assets. Assets can be further classified into further be classified into several parts. The very first part is non-current assets, the assets which can be sold, which the cash, the realization of cash can be held after an year. I'm explaining. Non-current assets refers to those assets which are held for continued use in the business for the purpose of producing goods and services and which are not meant for resale. Which are not meant for resale are known as non-current assets. Examples of non-current assets are long-term investment, fixed assets such as land and building, plant and machinery, computer and motor vehicles, etc. So the assets which we have purchased for our business use and which are not purchased for resale purpose are known as non-current assets. These assets used to enhance our productivity, and these are having generally having a long life. Then fixed assets can be further classified into two parts, tangible or intangible. The assets which can be seen or touched are known as tangible assets. Example of which are having physical existence are known as land and building, plant and machinery. Examples: land and building, plant and machinery, computer, motor vehicles, etc. Whereas if I talk about intangible assets, so those assets which cannot be seen or touched are known as intangible assets, and those which are not having a physical existence. Examples of such assets are goodwill, patents, copyrights, trademarks. These are several examples of intangible assets. Then comes to next point, current assets. So what is current assets? Current assets are those assets which are meant for sale or which the management would want to convert into cash within 1 year. The assets which we have purchased for resale purpose or which are the assets from which we are going to realize cash within a year are known as current assets. Examples of such assets are debtors, stock. Debtors generally used to pay us amount in a short duration. Stock, if I talk about the stock used to sale and we used to collect the cash from that in consideration of that stock. So these are the assets from which we can realize the cash within a period of 12 months. Next thing is fictitious assets. Fictitious or nominal assets. So these are the assets which cannot be realized in cash, or no further benefits can be derived from these assets. Such assets include debit balance of profit and loss account, and the expenditure not yet written off. Such assets, these assets are not really assets, but are shown in the asset side for the purpose of transferring them into profit and loss account gradually over a period of time. So these are several expenses which are actually not assets, but which have been treated, but which are being treated as your assets, not to overburden your profit and loss account in a single year. Next thing is capital receipts or revenue receipts. We have two different terminologies. Next terminologies are capital receipts and revenue receipt. The basic difference between capital and revenue, the things which are of non-recurring in nature is known as capital in nature, and the things which are of recurring in nature, जो कि बार बार होगा, repeatedly होगा, वो revenue nature का होगा. So, it is also necessary to make a proper distinction between capital receipt and revenue receipts, because the revenue receipts are shown in the credit side of trading and profit and loss account. Trading and profit and loss account, if you have remembered, we had discussed it earlier also. Whereas the capital receipts are shown in the balance sheet. These three items, trading, profit and loss, and balance sheet, these are related with the financial statement, which tells us our profitability of the concern and financial position of the concern. So when I'm talking about revenue receipt, so it used to record in trading and profit and loss account, and when we are talking about capital receipt, so it used to record it in balance sheet. So capital assets and capital receipt and revenue receipt. The basic difference is the receipts which are of non-recurring in nature. The capital receipts, if I'm talking about, these are of non-recurring in nature. The receipts which are of non-recurring in nature, and the receipts which are of recurring in nature are known as revenue receipts. Examples of capital receipts are amount received from the sale of fixed assets or investment. The assets which we have purchased, these assets are not purchased for resale purpose. So these are not your I can say these are not your repeated activities. If you are if you are selling any asset accidentally, so the amount you are receiving from that sale proceed, that can be treated as your capital receipt. Capital contributed by proprietor partners, money obtained from the issue of shares. These are the amount received from the owners of the business. If I'm talking about sole proprietor, the proprietor is the owner. If I'm talking about partnership, the partners are the owner. If I'm talking about joint stock company, the shareholders are the owner. So if they are investing the amount, these are the amounts which you are not getting on a regular basis. So if you are receiving these amounts, these are also an examples of capital receipts. Why? Because these are not a recurring activity. These are not examples of a recurring activity. Then amount received by way of loans. Loans you are not going to receive all the time, again and again. Then we are having several examples of revenue receipts as well. Money obtained from sale of goods, commission and fee received from service rendered, and interest and dividend. These are the examples of receipts which are of a recurring in nature. Then we have expenditure, any disbursement of cash or transfer of property or incurring a liability for the purpose of acquiring assets, goods or services. If we are purchasing any assets, if we are purchasing any goods, if we are hiring any services, so in consideration, if you are paying something, if we are transferring any property in consideration of it, the consideration will be termed as expenditure. Expenditure can also be classified into three categories: capital, revenue, and deferred revenue. When we are talking about capital expenditure, to any expenditure which is incurred in acquiring or increasing the value of fixed assets. So if you are acquiring any asset, if you are acquiring any fixed assets, non-current asset, so the expenditure you have incurred on acquiring that non-current assets is known as capital expenditure. As such, the amount spent on the purchase of erection of building, plant and furniture, etc., is capital expenditure. Such expenditure yields benefits over a long period of time. This is a very important point. These expenditure provides us benefit over a long period of time, and these used to enhance our productivity as well. Then comes to revenue expenditure, any expenditure the full benefit of which is received during one accounting period. The benefit of the expenditure is exhausted within a year, within an accounting period, can be termed as revenue expenditure, such as cost of goods sold, salaries, rent, electricity charges. These are the several examples of revenue expenditure. There we have been provided a difference between capital and revenue expenditure. Capital expenditure is incurred for acquisition or erection of fixed assets, whereas revenue expenditure is incurred for day-to-day running of the business. Capital expenditure is incurred for the purpose of increasing the earning capacity of the business, whereas revenue expenditure is incurred for the maintenance of earning capacity. For keeping the assets is an efficient working order. Capital expenditure yields benefit normally over a long period of time, whereas revenue expenditure provides us benefit for a maximum period of 1 year. Capital expenditure is written in the balance sheet, whereas revenue expenditure is written in the trading and profit and loss account. Then we have a next heading, deferred revenue expenditure. These are the expenditure which are of revenue in nature, but they used to provide us benefit over a period of more than a year, for the period of more than a year. There are certain expenditure which are of revenue in nature, but the benefit of which is likely to be derived over a number of years. Such expenditure are termed as a deferred revenue expenditure. The benefit of such expenditure generally lasts between 3 to 7 years. Normally, I'm going to give you an example of it. Normally, we used to think like your advertisement is a revenue expenditure. The expenditure you have incurred on advertisement is used to be exhausted within a year. But if we have incurred a huge expenditure on advertisement and we are thinking that the benefit of this advertisement is going to last us for a period of 3 years, then that such expenditure will be treated as a deferred revenue expenditure. Next is expense. Expense is the cost incurred in producing and selling of the goods and services. Expense is the cost incurred in producing and selling the goods and services. According to Finney and Miller, expense is the cost of use of things or the services for the purpose of generating revenue. Then we have income. Income is different from revenue. Amount received from the sale of goods is revenue, and the cost of goods sold is expense. Surplus of revenue over expense is called income. For example, if we have goods costing rupees 4 lakh and we have sold that goods for rupees 5 lakh, the sale amount 5 lakh is the revenue. Whatever the amount of sale proceeds you have received, that is your revenue. When you are subtracting the cost from revenue, 4 lakh from 5 lakh, the difference left is your income. 1 lakh is your income. Then we have profit. What is the difference between income and profit? So it is the excess of total revenue. When we are talking about total revenue minus total expense, the outcome comes is known as profit. In an accounting period, the total of revenue minus total of expenses is your profit. Then comes gain. It's a monetary benefit, profit, or advantage resulting from events or transactions which are incidental to business, such as sale of fixed assets, winning a court case, or appearing in the value of assets. Gain is incidental. It's not a thing you are getting on a regular basis. For example, if a building costing rupees 10 lakh is sold for rupees 12 lakh, 2 lakh will be 2 lakh. Your building is not your goods. Later, we are going to discuss the difference between goods and asset. So, if you are selling your assets and you are getting some profit, that profit is not of a regular recurring nature. You are not getting that profit on a regular basis. So that is a gain. That will be treated as a gain from the business. Next thing is loss. The term conveys two different meanings. First, it conveys the result of the business for a period when the total expense exceeds total revenue. For example, if revenues are 2 lakh and expenses are 2 lakh 40,000, the loss will be. If your simple, very simple thing, if your expenses are greater than your revenues, the difference will be treated as your loss. Then we have purchases. The term purchase is used only for the purchase of goods in which the business deals. In case of a manufacturing concern, goods means acquisition or acquiring of raw material for the purpose of conversion into finished goods. Here we have to discuss the difference between goods and assets. Goods are such thing which you have purchased for resale purpose. Goods can be in raw material, goods can be in finished goods. The things which in which you are dealing with, in which your business is dealing, and which you have purchased for resale purpose. So if you are purchasing that particular goods, can be known as purchase. And if you are purchasing an assets, that will be known as purchase of assets, that will be recorded separately in that particular asset account. But if you are purchasing goods, that will be recorded in purchases account, and that will be treated as purchases. Now, whatever goods you have purchased, if you're finding any defect in that, you can return that goods to the supplier, and that particular thing is known as purchase return. Sales. Sales means transfer of ownership of goods and services to customer for a price. For example, if Tarun sells a computer to Varun, the ownership of computer will be transferred to Varun, and Tarun is entitled to receive the agreed price to computer from Varun. The term sale is used only for the sale of those goods which are purchased for resale purpose. Again, sale is being used for goods only. Sale is being used for goods only. Then some customer might return goods sold to them. These are termed as sales return or return inwards. Then we have next point, stock or stock and trade. The term stock includes the value of those goods which are purchased for reselling and which are lying unsold at the end of the accounting period. The goods unsold at the end of the year may be known as stock and trade. Can be opening stock, can be closing stock, it can be opening stock. When I'm talking about closing stock, the goods remain unsold at the end of the year is known as closing stock, and similar goods when you're transferring to the next year is known as your opening stock. Inventory. In case of a manufacturer, there can be opening and closing inventory of four types: inventory of raw material, inventory of work in progress, inventory of finished goods, and inventory of stock and trade. It includes raw material. Includes inventory of raw material purchased for the using them in products manufactured, but still lying unused. For example, the value of cotton in case of cloth mills is the inventory of raw material. So whatever raw material you are having at the end of the year can be known as inventory of raw material, inventory of work in progress, and when the raw material has been processed but it has not been converted into finished goods, that can be known as inventory of work in progress. The goods have been converted into finished product but could not be sold or could not be transferred to go down, can be of inventory of finished goods. It includes the inventory of those goods which have been completely processed and ready for sale, but they are lying unsold at the end of the accounting period. In case of cloth mills, the value of finished cloth will be value of inventory of finished goods. Inventory of stock and trade, it includes the value of those goods which are purchased for reselling. Which are purchased for reselling means no further processing is required in stock and trade. Then coming to the next point, to trade receivables. So trade receivables refers to the amount receivable on the account of sale of goods and services rendered by company in the normal course of business. Trade receivables, if I'm talking about the trade receivables, refers to the amount receivable on the account of sales of goods and services rendered by the company in the normal course of business. If you are selling goods on credit, if you are providing our services on credit, the whatever amount we have to receive from the person concerned will be known as trade receivables. This can be classified into two parts: debtors and trade receivables. The term debtor represent to those persons or firms from whom we have sold the goods on credit, and from whom we have to receive some amount. Whereas the bills receivable are bills of exchange becomes bills receivable for the person who draws it and gets it back. It's an kind of a document where seller takes the promise from the buyer that the buyer will repay the amount after a specified time period. So that promise in in the form of a document is known as bills receivable. Then we have trade payable. Trade payable is the amount payable on the account of goods purchased or services taken in the normal course of business. Just opposite to trade receivables, if we have purchased goods on credit, if we have hired the services on credit, so from whom we have acquired the services, from whom we have taken the services, the amount we have to pay them, and those persons can be our will be our trade payables. Here, trade payables also includes two things: creditors and bills payable. The term creditors represent to those persons. The term creditors represent to those persons or firms from whom the goods have been purchased or services procured on credit, and payment has not been made to them. Some money is still owing to them. So if we have if we have taken the goods from them on credit, so those persons will be our creditors. And if we have promised, again the document come, which we were talking in bills receivable, which we have talked in bills receivable. Now, if I have promised to somebody that I'll pay this much amount after this much of time period in a document, that document is bills payable, and that's also a liability. Now, trade receivable is your asset and trade payable is your liability. Then comes to goods. Goods includes all those things which are purchased for resale or which are used for producing the finished products, which are also meant to be sold. Thus, for a furniture dealer, purchase of chair and tables is termed as goods, while for others, it is furniture and will be termed as an asset. So, goods are those things which have been purchased for resale purpose in a very simple term. Next thing is cost. Cost can be termed as the amount of resources given up in the exchange of some goods or services. The resources given up are money or money's equivalent, expressed in terms of money. Cost can be termed as the amount of resources given up in the exchange of goods, in the exchange of some goods and services. The resources given up are money or money equivalent, expressed in the terms of money. Next thing is voucher. So, meanwhile, if I talk about voucher is a document which provides authorization to pay on the basis of which the business transaction are first of all recorded in the books of account. A separate voucher is a thing. Voucher is a thing on the basis of which a transaction has to be recorded in the books of account. Then we used to come to a term turnover. Turnover means total sales made in a particular period. Livestock, domestic animals such as cattle, horses are known as livestock. If we are having some animals, so we are not going to write in the books of accounts animals. We'll use a term livestock. Then investment. Investment refers to the deployment of funds in the shares or debentures of a company with an intention of earning a return. So here we are coming to the conclusion of the topic. We'll conclude this topic. Thank you very much.